All right. What's going on, everybody? Craig, what's going on, brother?
What's going on, B-Red?
Just another Wednesday, but we're here to share. So hopefully everyone's having a great day. We don't have any viewers yet because we just went live. So people will obviously tune into the replay, Craig. So let's get started. Today, we are going to talk about the do's and the don'ts of the mortgage process. Just certain things to be aware of, certain things that we suggest doing and not doing. And we have a checklist. So I'm going to kind of read off this checklist. Craig is going to elaborate. I guess both of us will elaborate on certain things that we're talking about here. But the one thing I want to mention is that we're very thorough. So anytime we pre-approve somebody or start working on a loan, you're going to get this document, and it's actually in our system, which is secure. We get notified that you've viewed it. So we just want to make sure that you're aware of these things. So every time we send out a pre-approval or loan documents, that form is going out. So I don't expect you guys to remember anything that we go over today, maybe some of it, but you will have a checklist if we work with you that you can always resort back to read and keep yourself up to date with those things. Craig, do you have anything to mention before I start reading the do's and don'ts?
No, I mean, I feel like buying a property can be difficult. Getting a mortgage in general can be difficult. So being able to understand some pitfalls or things to look out for is super helpful, because you don't know these things, right? As a consumer or a buyer of a property or a borrower of money, you don't know these things. So it gives you an advantage to make sure that you're not doing something that's going to put yourself in jeopardy of possibly losing a property or losing out on an opportunity to refinance or purchase a home. So we put this in front of you to give you guidance so that you don't make mistakes. Everybody wants a smooth transaction. It doesn't always happen like that, but this is going to help ensure that you're taking the right steps of doing what you're supposed to or not doing something so that it won't cause mistakes later.
Okay, cool. Yeah, I agree. I agree with all that. So, how many times have we had people, which is kind of like why we created this list, because we've had people, even though we told don't do this or do this, they don't, right? Or they do, whatever the case is. So we kind of built this list based on our own knowledge, but also people not doing the things or doing the things that we told them not to do. So let's start. We'll start with going over the don'ts, right? Because there's more of those, obviously, than do's. So the first one I have here, Craig, is not to make cash deposits into your account. Now, I just want to say that you guys can make cash deposits, but that has to be documented. So, Craig, why don't you kind of elaborate on this?
Well, I think the first thing that you need to understand is that when we're looking at assets, right? And what are assets used for? Either for money that you need for settlement or to aid in eligibility, like reserve funds. So every bank account has, a list of transactions and has deposits. We're going to want to know that that money is your money. All these loan programs have guidelines and rules regarding making sure that the money in your account or the money that we're using for settlement on a statement is in fact your money. So by depositing cash into your account, it's hard to trace where that cash came from. So like you said, I don't think it's impossible to trace cash. I think it's difficult to be able to come up with documentation to support a cash deposit. Things like employer-related deposits, an IRS refund, transfers of funds from one account to another, money from your retirement account. These are all easily sourceable transactions, right? I can source based on a paycheck that you had money coming from your employer, or on a line item that it's from your employer. I can source on the transaction on the statement that you have an IRS refund. I can source that you transferred money from another account. it's hard to document where that cash came from and that we can verify that it was your money to be able to use. And if I don't, you were going to mention something about elaborating on the cash deposit in certain situations where you might be able to document.
Yeah, I'm thinking more like if you had a wedding, right? In some cases, you might get cash that's from a gift. And, the whole thing is you always want to talk to your lender first. So if you see it on here and we tell you not to do it or to do it or whatever the case is, if you're questioning something where you need to make a cash deposit, talk to your lender first so that we can advise you how to do it, right? Or let's say you make a cash deposit of $3,300.19, and then we could document that your father gave you a gift because they had a withdrawal of $3,319, right? It's pretty much, the writing's on the wall. Obviously, it came from him. It's the same exact amount. But now, if he shows us an account that he did a withdrawal of $2,500, and then you're showing us a deposit of $3,319, it's going to be hard to say that these are the same, right? So the basic thing is that you want to be able to document the money going into the account. And if we can't document it, then we have to reduce verified assets. So what I mean by that is if you have $5,000 in an account and there's a $2,500 deposit that we can't document, then we can only use the difference, which is $2,500 in verified assets. And if that's not enough to close, then you're going to have an issue. So regardless, when it comes to assets, how much is needed, if you're going to make deposits, you always want to communicate with your lender just to make sure you're getting the right advice. That's pretty much it.
And I think it comes down to, like you said, it's being able to source the money. Where did it come from? Is it an acceptable source? In that situation that you mentioned, a gift is an acceptable source as long as you meet the criteria for an acceptable donor or acceptable gift. So, most of the things that we're going over today, it's kind of tells you, hey, if you have a question about anything, right? If any of these things present a red flag to you, like throw your hand up and circle back to us, because then we're going to confirm whether something that you're doing is wrong or something that you're doing is right.
All right, so moving on. Don't purchase a new car while you're in the middle of escrow. I think we can kind of rule out a few of these because we have that. It's kind of repetitive. I think that comes with anything, right? Purchasing a new car, applying for any type of unsecured or secured loans or credit cards, boats, whatever. You guys don't want to apply for any new loans while you're in the middle of escrow.
I think that the reason why it's on that list, Brad, is that's a common thing that happens, right? Because next to a home, I feel like a car is an important thing that you need in your life to be able to get around and get to work or do whatever. So I think that's why it was separated on this list in a sense, because we see that more commonly where, somebody is getting a new car and during the process of being pre-approved, and that is a larger obligation, right? So it's one thing if you have a credit card and your minimum payment is $50 a month. It's another thing if you just bought a car and it's a $700 obligation a month. It could drastically change your eligibility. So, and again, this is not to scare you, not to say that it won't work all the time, but if you circle back to us and find out, okay, what's the impact of me getting a new car? It might still work, right? It's not the fact that it won't work. It's the fact that if you don't make us aware or you're not sure of the impact, it could mean the difference of you getting a loan or not getting a loan.
Yeah, I mean, that comes, it's always that, that same theme. Talk to your lender first, because sometimes these things are needed. Sometimes you need to apply for a credit card, or sometimes you need to buy a car. Whatever the case is, we don't want to stop you from doing things that are needed, but we also want to give you guidance so that you don't jeopardize your home purchase, right? Because that's most important, your living situation. So that also goes with being a co-signer. So it's all the same thing, whether you're applying for credit or somebody else is doing so and you're co-signing for them, it's going to show up on your credit report. It's going to affect your debt to income ratio. And here's the thing, a lot of people, which you'll agree with, Craig, they have this misconception that, we ran their credit 30 days ago, so we're all good. Well, the reality is we're going to do a soft pull as we approach your settlement date, just to make sure that there's been no new debts obtained, right? That could affect your, being able to pay the loan back. So keep that in mind, that when you are making changes to your debt load, you definitely want to advise your lender. You want to ask them for advice and essentially permission, but you also want to let them know so that we're aware of it, because we don't want to find out in the 12th hour that you got a new car or a new credit card and now it's affecting your financing and we have to restructure things. So
not only that, I feel like if we have you pre-approved and eventually we have to use a new credit report, let's say you've been pre-approved for 90 days and haven't found a home, and by the time you finally go under contract, we might need a new credit report during that process, because that credit report is only good from 120 days from the time we pulled it until the time it funds. So what if we have to pull a new report, and the fact that you not only got a new car, it might not affect your ability to get the loan, but it could have affected your credit score, which affects your interest rate, because your score could go down by applying for a car or obtaining an installment loan. So that's just another thing to think of, that how that might affect you. Even though you might be able to afford the car, what did it do to your interest rate, right? Possibly, or your credit score. So that's something else to think of too.
Awesome. Yeah. So adding yourself to someone else's title. So that's kind of similar to applying for a new credit in a way. Craig, why don't you elaborate on how that could affect somebody?
Well,
what I mean by that.
So when you're adding yourself to the title of a property and you're not on the note, in the eyes of a lender and you qualifying for a loan, you're still obligated to a portion of the property, right? You as an owner are obligated to pay property taxes and homeowners insurance. And even though there might be somebody else on the title or the mortgage that's paying those items, you would still be obligated as far as the taxes and insurance are concerned, at minimum, I would think, for those obligations. So if you add yourself to a title of a property, let's say you want to add yourself to your parents' property, right? They want to add you to the title, although there may not be a mortgage on that property, or there may be a mortgage that's paying the taxes and insurance. Whatever those taxes are, if those taxes are $6,000 a year, that means you have a $500 a month in obligations and taxes. If the insurance is on that property is $600 a year, you're at what, $50 a month in obligation. So that's total of $550 in added liability that could affect your debt to income ratio, inevitably your buying power, and the amount of that you want to borrow. So I guess this is kind of what we meant by don't add yourself to someone's title.
Yeah, it is. It's exactly what we meant. So, it's just because people don't think about that. I'm sure you can count on at least one hand the amount of times that has happened this year. Luckily, I remember a few circumstances that didn't affect them. Luckily, they still did qualify, but you just don't want to do that. You don't want to do anything. Again, I'll just go back to that theme. You don't want to do anything without advising or being advised by your lender.
And I feel like to add to that too is that a lot of people might not know that being on the deed of a property is really considered ownership of a property, right? You might have just done something like, hey, I want to add myself to the deed. And then when you apply for a loan, we find out during the process that you're actually on the title of another property. So knowing that before you apply, like what your position is as far as ownership is concerned, if you're on the deed of a property, you're technically owner of that property, or, have a percentage of ownership interest. And you want to let your loan officer know, hey, I do own a property. I'm not on the mortgage, but I am on the deed. And then they can kind of give you guidance properly from that point forward, or we can.
Yeah, we actually just had somebody that happened with, but they didn't get added to the title after the fact. They were on a title and just didn't realize it. So,
yeah.
All right, great point. Back to assets, because that's the way the list is going, is don't accept funds from someone else for the purchase of your home unless prior arrangements have been made with your loan officer. So we're talking specifically about gift funds. There's certain things that have to be done when getting a gift. We have to document that it's coming from either a family member or someone that you have a long relationship with, because the down payment, the reason we require a down payment isn't because you don't afford to borrow the full amount, but it's essentially so you have some skin in the game. So I guess the agencies that create these rules are inclined to believe that if you were to get a gift or a loan from somebody that you don't know or don't have a relationship with, you might be more likely to walk away from the house because it's not affecting you. Whereas if you're getting a gift from a family member, walking away from the house and losing that investment could affect your relationship with that person. So I guess you're less likely to do that when you get it from a family member. And an underwriter is more inclined to believe it is a true gift and not a loan because you can't borrow the money for down payment, right? So some of the things that when we talk about making arrangements with your lender, that we have to document that it's a family member or someone you have a long-term relationship, and we have to get documents to source that gift. So we have to get a gift letter signed by the donor. We have to get a copy of the donor's bank account to make sure that they did have the ability to gift you that money and that it did in fact come from them, right? And then we have to document it with your account showing that you've received the money. So that's kind of, I guess, what we mean by gift funds and, why to reach out to your lender. Is there anything you want to add to that, Craig?
Yeah, a common example that I see of this a lot is during the beginning stages of making an offer on a contract, where you might not even need a gift and you're using funds from somebody else that gave you money to put down as a deposit on the contract, right? So when you're going to buy a house, they call that an earnest money deposit. Typically, you're putting in good faith an amount towards the contract that says, okay, I'm putting this much down. If you violate the contract, you're almost in jeopardy of losing that money. So it shows that you're serious about purchasing a house and that you're basically abiding by these rules set forth in the contract. So what I mean by getting a gift, in a sense, is that we've had occasions where somebody was given money or gave the deposit on behalf of somebody that's purchasing a house. So I'm, the son, my parents said, hey, I'll put the money down on the contract. And we don't know that you didn't use your money, in a sense, to put down on the contract. If we can't verify that it came from your account, that money that you put down on the contract, then we can't use those funds. So I feel like even in the beginning stages, in understanding that any money used towards purchasing, whether it be the money that you need at settlement or the money that you're putting down at the beginning stages of the contract phase, has to be verified. And we have to source it back to you. And I only say that is because it's harder for us to trace that deposit until we're, in the mortgage process and we find out where that deposit that earnest money deposit came from. So that's important too, I feel like, is that some people don't realize that, hey, my mom gave me this money. Well, we can document that, but knowing in advance and understanding to circle back to your lender, circling back to us and making sure that money is usable, even the money that you're putting down initially on the contract.
So the next thing is not to make any major purchases and not borrowing money, like not making a major purchase in the sense that you're borrowing to get a car, like a car loan or something, but just coming out of pocket, right? Like using your funds in your bank account to maybe buy a boat or buy your appliances. That happens all the time. People start buying furniture and appliances before they own the home. First of all, don't count your chickens before the eggs hatch, right? Like I've heard that saying a million times. So kind of the same concept here. Like, why would you buy furniture and things to, for the house if you don't own it yet? Because there's no guarantee, anything can come up. Not so much with the mortgage loan, but anything in general, title, the seller could back out, any little thing, appraisal, the house might not appraise. But the reason we're saying not to make any major purchases is because, or at least without advice from us first, right? Because if you go out and spend $10,000 on a used car, that's going to diminish some of your funds. And now it might leave you short of what's needed to close on the house. So you want to be careful before making any major purchases that it's not affecting your ability to close, to go to settlement, to have those funds available that are needed. Craig, you want to elaborate? Anything I missed there? Or
no, I think that kind of relates to the other things we were talking about with regards to credit and stuff, applying for new credit. But I feel like the next section is don't apply for new credit, don't open a new credit card is pretty similar. Don't transfer credit card balances. These are all similar categories. Whenever you apply for credit, there's an inquiry associated with that, right? So we can see when you've applied for credit, and sometimes there's delays, right? And you obtaining that, or that debt actually reporting to the credit bureau. So you might have obtained a credit card 3 weeks ago and it doesn't show up on your actual credit report from the bureau standpoint for a month. What we mean by, don't apply for new credit is that we're going to see that you've inquired about new credit, and we're going to find out. And once we find out, it's getting documents, even if that's a small credit card, right? It could be a $30 minimum payment. It has no effect on your ability to qualify for a loan. We still have to document it. So it's one thing to say, hey, you don't qualify, and that would be awful. We want everybody to not do something that's going to jeopardize their ability to qualify for a loan. But I feel like even if you do qualify and it wasn't a big deal, and you make enough money to cover the loan and all your other obligations, even with the new credit, I think it's the documentation part of it. What has to be done in order to support the opening of a new account, right? So that could cause delays, and people don't want to be delayed and hear that, I opened up an account. It's a $500 credit card. It's only a $20 minimum payment. I'm going to still qualify. Yes, you will, but we still need to document that, right? We still need to be able to show evidence of that account being established, and it could take some time to get that documentation to support that, right? I've had that happen before.
So the next few are kind of grouped together because I think they all kind of relate to one another. So don't pay charge-offs, don't pay off collections, and don't close any credit card accounts. So this kind of goes against what most people would think, is that by paying off a charge-off or a collection or closing a credit card would have a positive impact on them getting financing. But in some cases, it would have a negative. So it could reduce your credit score, number one. That's most importantly, right? Because if you pay off these like a collection, for instance, people think they associate a positive thing with paying off a collection. And in some cases, the last time the collection reported might have been 3 years ago. Now you pay it off. And if they report that collection was paid off, the way the algorithm works, the scoring model, it's going to show that collection was paid off recently. Now they're going to report. And there's just as far as the scoring model goes, it's going to, because of that type of account that's reporting, it could reduce your credit score at first. Now it's going to be paid off, marked closed, hopefully. So going forward, your credit score will rebuild, right? And it'll stop reporting negatively. But that initial instant where it's paid off and they report, it could be reporting and they hadn't reported in the last 3 years. So it could affect you negatively.
Yeah. I just want to add another point like you said, it's, overall, it's a good thing, right? Getting rid of bad debt is a good thing. And eventually time heals that account, right? The longer there's no delinquency, the more you think that your score is going to go up. I feel like most of these issues are resolvable issues to an extent. It's the time crunch that you're in resolving those issues, right? So when you're under contract, you have deadlines you have to meet. It's hard to do all of this while you're working your full-time job and having us ask you to do X, Y, and Z, and then have documentation to support everything that we need to have done and accommodate a deadline that you have to meet, like a commitment date or a settlement date, right? So in most part, Brad, you would have to say, right, we've dealt with all this and we've resolved issues even that happen on this list. It's the time constraint that you're up against when you're under contract. So kind of knowing these things before you go under contract is super helpful, because then you're not putting yourself in a position not only to jeopardize the ability to get the loan, but if we do run into a problem, it's how much time do we need to fix that problem?
Yeah, I agree. Yeah, because it's, and especially closing, sometimes they're fast. Sometimes we're given 20 days, 30 days, 45 days, depending. But there's still not a whole lot of time to get a mortgage done, regardless of what you think, because there's so many people involved. So when you start adding layers to it, things that could prevent us from doing what we need to do in a timely fashion and adding to our workload, then it could put you at risk on not closing on time.
So we kind of went over the don'ts, and we just because we're limited with time today. Let's go over some of the do's that on this list, and there's only a few, but I feel like we can address some of the do's on this list.
Yeah. So, I mean, I'll just start by consulting with your loan officer. Seek their advice, no matter what changes you make. And we've kind of mentioned that a few times on the call here, is that you always want to let us know, or if it's not us, whoever you're working with, know what is going on. So any changes to income, employment, credit, assets, any changes, let us know, because we might have to restructure your financing, right?
The next two, Brad, are pretty similar with anything. I feel like do continue to make your mortgage payments, your housing obligation on time. Do stay current on existing credit cards and other accounts. This is important because, like Brad had mentioned before, we do a refresh report and 10 days prior to settlement to see if you've accumulated any debts. But God forbid you go 30 days late on an account and we need to pull your credit report again. That can significantly impact your credit score or put you in a position not to be eligible. And I think what most people, think when we say staying current, it's making the minimum obligation, right? Making whatever's required of you on your billing statement, not having to pay the entire balance, just making that minimum payment. And and I don't know that most people know this, but as long as you make that minimum payment within 30 days of the billing cycle, that creditors can't legally mark you late to the credit bureaus. They can't document that you were late because they only recognize 30-day latenesses or more. So it's important to stay current on all your obligations, including credit cards and your minimum payments.
Yeah, and the easiest way, I think, just a little piece of advice here, something I do personally, is that I set up auto payments for all of my stuff, my credit cards, and the bare minimum. Like there's things that we're paying extra on, right? Like you might throw an extra $200 at your car payment or towards your credit cards or your mortgage, whatever the case is. But if you set up with every one of your creditors, if you set up automatic payments for the minimum, then that minimum payment's covered. And then if you make a payment beforehand, then that payment won't go through. Or if you want to add an extra $100, but at least you're guaranteed to not miss payments because life happens, right? I'm huge on having oversights in life in general, just missing things unintentionally. So that's why I personally have it set up that way. So just a piece of advice. You guys should definitely set it up so that your payments are being made automatically.
I think this next one is super important, and you wouldn't believe how many times we've encountered this situation. So, do keep working at your current employer. So, look, you obviously have a bigger problem, right? If a bigger problem than buying a house if you get laid off or you're terminated from your position at work. But if we aren't aware of something that can happen, even right before settlement, I've had occasions where people have been fired the day of settlement and we can't close that loan. But the reality is that if there's changes at work, if something happened, you have to make us aware. Things happen in life, right? You could be under contract and get let go. That can happen. But it doesn't mean that there aren't solutions, right? You could be able to find that a job's very similar. You had an offer on the table. In the next 2 weeks, we might be able to extend settlement and talk to the seller and tell them what happened, right? So knowing these things and letting us know what's going on with your employment if something does happen where you're let go, I think is super important. We don't want to find out that you're avoiding that, because you and I both know, Brad, we're going to, up until the day of settlement, be verifying employment, at least on a verbal level, with your employer. So it's important to let us know when you're pre-approved, right, if something happens with employment, whether it's to change for the better or you got let go from work, you have to let us know so that we can give you guidance. If you got a promotion and you got a job offer and you take that job offer, we still want to know about it because we have to update on our end, and there's certain guidelines that have to apply to your situation with you having a new job, right? Let me give you an example. If you're a salary waged employee right now and you're pre-approved with us as a salary waged employee, and then you take a job that's 100% commission. Well, commission employment and income is treated differently than salary income and position. And that could affect your ability to get a loan. So even though you have the potential of making a lot more money, right? There's a significant difference in the qualifying aspects for somebody that's salary versus commission. So that's just an example of, how this, I interpret this do keep working at your current lender, because keep staying at your current lender, we don't have to worry about
current employer. You're saying current lender, but yeah, I know what you mean.
Or current employer.
Stay with your current employer. Yeah, I had, just to kind of give you guys a situation, I had a client years ago that left his job a week before settlement and didn't tell me until we were doing the verification and said, "Oh, I didn't know that I had to tell you that." So it's always going to change things. And when you change employers, we're going to require different things. In some cases, all we need is a pay stub to document that you started working. Maybe it's the same industry. You're doing the same thing. You got a pay raise, whatever the case is. So our underwriters are inclined to believe that it's stable, but if you go from, I don't know, working at Walmart to now, being a mechanic, they're two entirely different industries. So now we might require that you have 30 days worth of pay stubs. So documentation requirements change and obviously vary depending on situations, people, jobs, the type of loans that you're applying for. So I think it just goes to the last thing to do is call and speak with your loan officer before or when something changes, whether it's assets, employment, income, or debt load. So you always want to reach out and get advice. Now, if you guys have any questions, you can contact us. You can obviously, depending on what platform you're watching this on, you can send either one of us a direct message, or you can reach out via email, check our website out, or call our 866-416-7156. So any one of these ways of contacting us, direct message, visit acreloans.com. There's a lot of great information on there. You can call us or you can email my loan team. It's 1:05. I think we've kept you guys long enough. Those that are watching, your ears are probably bleeding, but if you have any questions, we're definitely here to help. We do like to take the hand-holding approach, so there's no expectations or obligations. Our goal is to help as many families as we can. So if you know anybody that might be looking to buy, sell, or refinance, feel free to make an intro. It doesn't cost anything to have a conversation, and you guys aren't held to anything. But if you do reach out and we can get an application done, we'll be more than happy to do a thorough review to kind of show you where you stand. Craig, you have anything to add?
No, appreciate you guys tuning in.
All right, guys, have a great day. Thanks for watching, and we'll catch up soon.
Take care.